This episode of the Construction Record is brought to you by the Ontario Sewer and Water Main Construction Association. Clean water is everybody's business.
Hello, I'm Warren Fraud, the digital media editor for the Journal of Commerce, and one of the co-hosts of the Construction Record. We can all agree 2020 was a year full of economic doom and gloom, but there's reason for optimism, as you'll see in this episode. Daily Commercial News and Journal of Commerce National Managing Editor Vince Versace is speaking with ConstructConnect Chief Economist Alex Carrick about the economic trends that will shape both construction and the wider economy in 2021. Carrick's optimistic about the economic prospects for the next year because of the emergence of vaccines to combat the COVID-19 pandemic, which has ravaged both the Canadian and global economies. Once enough of the population is immunized, the economy will regain steam, he thinks, and he also cited the stark rise of savings rates due to people continuing to work but simply not having anywhere to spend their money, as many economic sectors slowed down or closed. As restrictions ease, pent-up demand will mean people will travel, go out to eat, and spend money again. Commodity prices might also push upward because of renewed interest in infrastructure projects. Some of the spending will go towards new data centers, 5G networks, and other information technology, but other commodities should also rise. This will affect both the cost of construction and push forward capital spending for owners of resource projects in a way Carrick says we haven't seen in a decade. So, without any further ado, let's join Vince Versace and Alex Carrick up next.
This feature interview is brought to you by the Greater Toronto Sewer and Water Main Contractors Association, building water and sewer infrastructure excellence since 1957.
Hello everyone, this is Vince Versace, National Managing Editor of the Daily Commercial News and Journal of Commerce, joining you today for your first episode of 2021 on the Construction Record. And who better to start the year off with than my colleague here at ConstructConnect and one of the wisest men when it comes to all things construction economy. And with that glowing introduction, I have with me
Alex Carrick, Chief Economist of ConstructConnect Canada and the United States. That thing about wise there, I almost forgot my name there, Vince. Threw me off.
Well, we've been associated now together about 13 years, going on 14, Alex. I think I can say you're very wise. I can categorically say that right here on our podcast. You are a wise man.
Well, thank you. Sorry. That's
no worries.
My New Year's resolution is to be nice to everybody. So you're a wise man too, Vince. Take that as
it's smart enough. Yeah. If I only had a podcast for the first couple of years, you and I were hanging out. Not so nice to me, were you? Well, I hope we got our listeners laughing as they kick off their year with us on the Construction Record podcast. Right. And the reason why I want to talk to you, Alec, and I think our listeners or readers or subscribers should really kind of get a flavor from you on what you're seeing as far as the construction economy landscape for 2021 and what you're going to be keeping an eye out on and what's of interest to you. I think that would be of interest to everyone else as well. Well,
thank you. Yes. No, and I'm delighted that you've asked me to do this too. I always enjoy doing these.
Well, no, and we always enjoy having you. So why don't I start off with that? Here we are at the beginning of 2021, and what comes to mind, maybe domestically or North American-wise, as far as construction economy? Is there any good news people can expect?
Well, I've spent the last 9 months, I guess, really talking very negatively. I've certainly done a lot of webinars and a lot of sessions with various groups, and a lot of the time I've said things that I think maybe have bothered some people. And so I remember early on, people were talking about V-shaped recovery and that things would turn around quickly and so on. I never thought that would happen, because that's not the way the economy works. When you lose as many jobs as we lost between February and April, it's very hard to bounce back as quickly as all that. Now, there's been parts of the economy, and maybe I can get into that later, where there have been V-shaped recoveries, and it's been things like retail trade. And retail trades a big part of consumer spending, but it's not the only part of consumer spending. The other part of consumer spending is on services, and that's where you get into the parts of the economy that have really had trouble, because you spend on travel and hotels and motels and eating out and so on. So that's where the job losses have been, and that's where the job recovery has to take place. But other than that, I am feeling more optimistically for three reasons, I think. And Vince, I could tell that you were going to get in there for a second. So
yeah, no, it wasn't to interrupt your stream of thought. Just I was thinking, what in particular? What are the reasons why you're feeling that way? So go ahead.
Yeah, well, the three reasons, and there's others as well. I think the political situation is going to calm down a bit, especially in terms of our dealings with the United States because of the change in the election down there and so on. So again, we can get into that later. But the three ones that I primarily key on are, of course, the vaccine, because everything's flowing from coronavirus infections. Right now, the outlook for the economy has turned down in the last quarter of this year because there were reopenings of restaurants and so on, but they've had to be reversed. In a lot of cases, they had to be reversed because the vaccine came roaring back in the late fall and the winter. So having a vaccine and the promise of a vaccine out there, that's certainly a plus. And I suspect that maybe the vaccine will be disseminated and out there faster than we're being told. People always like to be conservative when they say this. There's a number of providers, and there's certainly going to be a lot of pressure on them to get the vaccine out. So when they talk about blanket coverage by the summer, maybe it'll happen a little bit sooner than that. But anyway, we've got to start seeing that curve go down. And having the vaccine is one really good development. Then a second one is there's a lot of talk about the savings rate. The fact that this is a number. It's a number that's published by statistical agencies and governments around the world, and it's actually a residual figure. So it's not really what you think it is. But nevertheless, the savings rate has shot up. At one point, in Canada and the United States, it was around 25% to 30% of disposable income. And there were two really big reasons. And one was that people haven't had anything to spend their money on. I mean, you haven't been able to go to concerts and entertainment or to dine out on Friday nights or the weekend or travel. And so that's one reason for people being able to pad up their bank accounts and so on. And then the other big reason has been that even though people have been laid off, the government has been pumping a huge amount of money into the economy. The government in Canada has given out all kinds of money to students beyond unemployment insurance. And in the States, it's been unemployment insurance, but then also stimulus checks. So when you look at the amount of income, that has shot up and the expenditures have gone down. So you got these really big savings rates. People have the money. Whether that'll be unleashed or not remains to be a bit of a question, but there's a lot of pent-up demand. And if you think about travel, a lot of people are addicted to travel. You hear people talking, they're just dying to get away on a trip or a vacation and so on. So once they feel confident that they can do it, that really will come back, partly because there's going to be the money to do it. And it's the same with eating out. I remember even this summer, I mean, my wife and I, we went out for a couple of meals this summer. Haven't done it since then, but man, when we sat there at the restaurant, we were sitting there and we had a waitress come over and take our order. we thought we were in heaven again. We were just delighted by that.
Right,
And
of
then,
course.
yeah, yeah. And then a third one might be that commodity prices are maybe starting to firm up again. And China, for example, has got a big infrastructure program that they're talking about, spending huge amounts of money. Now, it won't be in the same areas that they have in the past. It won't, or at least not to the same degree as in the past. It won't be things like roads and airports and so on. A lot of it will be on 5G networks and telecommunications systems and data center stacks and that sort of thing. So it's not entirely clear what that's going to mean in terms of commodity demand. But even oil prices, they're better than they have been for a while. And any improvement in commodity prices, it's a two-edged sword for construction. On the one side, all building materials are based on commodities. So if you have commodity price increases, you have the cost of construction going up. But there's another side to it. And I think that side's really more important for Canada now than worrying about the cost. And that is, when you have commodity price increases, the owners of resource projects, that's an incentive for them to go ahead with capital spending. And really, we haven't seen that in a decade. So those are the sorts of things where I think we can start to look a little bit more optimistically. And our dealings with the United States, that's an interesting subject too, in terms of the new administration down there.
I wonder, when you mention the Canadian government in particular, pumping funds into the economy, there was a running joke for a little while halfway through the pandemic where it felt like every day Prime Minister Justin Trudeau was throwing money out of helicopters, to keep, there was always an announcement of some kind to keep the economy running. And now we're starting to see a little bit of that coverage in the commercial media, and you see the opposition starting to peck away a bit at, okay, well, exactly how much money is being spent? Is it being, is there accountable spending? And when are we going to start paying for this? So as an economist for your end, is it still too early to project the heavier impact that's going to be on the regular taxpayer right now? Is it a matter of just getting through this hurdle right now of getting the vaccine out and getting people back to some kind of new normal before you can start worrying about how you pay back something as big as the expenditure that's been put forth?
Yeah, well, that's a really good question because it is about the timing. And I think this year, 2020, which will be a year that will live in history. Which is another subject. I to some degree, I feel fortunate that I'm writing about the economy now because this is a year that's going to change economic textbooks and so on, which is really something. But the size of government debt, that is certainly going to be a problem. However, let me just begin this discussion by quoting two numbers, and it's the clawback ratio, the jobs clawback ratio, because you've got to have employment returning to where it was before the pandemic, before you start to really think that we're out of the woods here. And the huge job losses were between February and April. Like in the United States, it was a decline in employment of about 13%. In Canada, it was larger, it was a decline of about 15%. Since April, though, Canada has actually restored more jobs, relatively speaking, than the United States. So Canada's jobs clawback ratio is around 80%, and that's pretty darn good. In the United States, their jobs clawback ratio is still only around 50%. So if you're talking about adding a lot more stimulus, I think maybe the Canadian government is in a more comfortable position than the U.S. is. And the U.S. in Congress, you know that they can't come to any agreement about how much more they should help out. And their cities and their states, it's a little bit different down there in terms of the financing, and their cities and their states are probably, they're suffering more than the cities and states in Canada. And it's probably there where the help is needed more. And it's about sustaining or getting employment back and having the income support that's needed more south of the border than it might be here. Now, I would say if we want to get into the subject area of where some problems, really significant problems, might happen, if you remember back in the 00s, in America, there was a lot of talk about the twin deficit problem.
Right.
And that was the everybody was saying. It was the Republicans more than the Democrats because of who was in the White House, sort of thing. But there was a huge amount of concern that the federal government deficit was around $1 trillion, and that the foreign trade deficit was around $1 trillion. Well, after the 2008-2009 recession, both of those deficits declined substantially, and they eased for quite a number of years. But they're now both back full bore. The government deficit in the U.S. is likely to be north of $3 trillion. And well, it actually is for the year that ended on September 30th, it was $3.1 trillion. And then the goods trade deficit, it's back up to about $1 trillion. And the problem that you have when you've got those kind of deficits is in terms of interest rates, because central banks everywhere are saying, don't worry, inflation's not going to be a problem, and we're going to keep interest rates down near 0% for a long time. That's not so easy to do when you've got countries, a lot of countries that have got huge deficits, and they're all competing to draw in foreign money to buy bonds and so on, and particularly when you got a trade deficit, because again, this is an economic thing, and I'm sorry to throw this out there, but the balance of payments for any country is always zero. And that means that the balance of payments is made up of two items. One is the current account and one is the capital account. And the current account is your trade in goods and services. It's exports and imports in goods and services. So if you got a huge deficit in terms of your exports and imports, you've got, okay, so here, I'm going to simplify this. So you got money flowing out of the country because you're importing more than you're exporting. You got to have that money come back into the country, and it comes back into the country through the capital account. And that's where you attract money to invest in the securities that the government issues. And if you've got a lot of countries that need that money, there's one of the chief ways to get it is to have interest rates higher than another country. So when the central banks talk about keeping interest rates low forever, they may be blowing smoke. That it may not be possible for them to do that for much more than a year. So yeah, the deficit problems, that's something that's out there. And that's going to be quite the issue as we get further into this. But of course, as you have mentioned, as everybody is aware, we have an immediate hurdle to get over first.
Right. I find it interesting. I don't know if it's probably too early to extrapolate any type of inference, but during the early days of the pandemic, as we were recording podcast interviews, I was coming across this recurring theme of now's the time for construction to reset their manufacturing line, you know what I mean, how they procure their supplies and materials, to find a way to be a bit more efficient, maybe build more domestic type of supply chains versus what was pre-pandemic, which was the lowest common denominator, the lowest dollar that you could find for your supply material supply chain abroad. Basically meaning if you're in Hamilton and you can find these widgets cheaper in China, go for it. Instead of, having a supplier that's local to Ontario, so you can kind of circumvent any type of issues like a global pandemic in the time of need.
Yeah.
Have you seen any early evidence of this at all? Is it possible to see any type of early evidence of this at all from the way you look at the construction economy?
Well, this is a really interesting topic here, and I think I will tell you something that will get your readers thinking at some point. This is kind of along the lines of, do we go from globalization to deglobalization? Because everybody's talking about this. And in the U.S., of course, there's the Buy America policies, and we know that Mr. Biden wants to support labor. He wants to support the unions and so on. And deglobalization, for one thing, it may not be possible to the extent that people have been thinking about it, because a lot of companies are going to go out of business or have gone out of business because of the pandemic. So if you're looking for things, it's possible that you may not be able to find them without going offshore, because other economies have recovered faster than the U.S. and Canadian economies have. And I'm thinking about economies in Asia. But the other really interesting thing that nobody's talking about in terms of deglobalization, and as for the statistics, we'll have to see about that. But I don't doubt that there is going to be an effort towards deglobalization. But deglobalization changes the balance of power in labor relations, because we have spent darn nearly 20 years where the balance of power has shifted over towards management, because you have, as a worker, you have known that if you don't like your job and you're too disgruntled and you express that your employer can offshore what you're doing. So there's two interesting phenomenons at work here, because high tech has certainly shown its worth in this pandemic, and for a lot of us, maybe our jobs can be done remotely over the internet or whatever. Nevertheless, there are going to be jobs where, if it's deglobalization, there's jobs in logistics and so on that will be repatriated to domestic economies, Canadian and U.S. And that's a change. That is not something that has been prevalent for quite some time. It'll be interesting to see if bottlenecks start to develop in terms of delivery and so on, if there starts to be the kind of labor unrest that I used to see earlier in my career. And that has an impact on inflation, and it works its way through a lot of other parts of the economy. So that's something to watch. That's something to really watch. It's a shifting of the balance of power between management and employees if deglobalization really takes a hold. Now, as for Canada being affected in terms of this, there's a lot of Canadian subsidiaries of American companies. American companies are used to working with their Canadian subsidiaries. There's a lower valued dollar. I don't think deglobalization is going to have the negative impact on Canadian manufacturers. Plus, we've now got the new trade agreement, the USMCA. So I don't think that's a real concern for us. I think deglobalization would be more about trying to reduce connections across the ocean, overseas connections.
Right. Interesting. And you kind of mentioned something in there that has been popping up as well in our general discussions with folks in the industry. It's the domino effect of having more people work from home remotely, and proving that to companies and to owners that, you know what, that specific floor you rent out on Bay Street in Toronto, you know what I mean, or in downtown Montreal or Vancouver, you may not need it. You know, you're probably better off maybe with some satellite offices. That has a knockoff effect. That has an effect on construction as far as maintenance, remodeling. One would imagine. But when I hear these things, and I'm kind of loading you with two questions here, I think about Calgary's vacancy rate, their downtown vacancy rates in their offices, which was horrible already before the pandemic, right? Because of the impacts of what's happening in the oil patch.
Yes.
Where does this leave some of these city centers now? You know, that had all this office space. Is it still too early? Is it a wait and see maybe approach? Once again, another wait and see angle?
Well, yeah, that is a key question. How much will society change? What will society's preferences? How will that turn out? Statistics Canada is saying that about a quarter of the people who are working a regular work week are now working from home, and it's having a huge impact. It has an impact in terms of residential markets because it helps to promote single-family housing as opposed to multifamily housing, and so housing is it's one of the bulwarks of the economy, but it's more on the single-family side, and that's why you're seeing condos. Listings of condos up and so on. In terms of office building construction, sure, no, this has a huge impact. Now the pendulum has swung way over because of this move to working from home. I don't have any doubt that the pendulum will swing back to some degree because there's a good reason for companies wanting to have their employees in an office. And it includes some kind of surprising reasons. For one thing, it makes collaboration easier. That's obvious. But it also makes training easier. It's easier to train somebody if you can look right over their shoulder and see what they're doing. And the other one of the reasons that I really like is because a lot of employees, I mean, I just love this as an explanation. A lot of employees like to suck up to their bosses, and it's harder to do that when you're working remotely and you've just got them on your video call sort of thing. So the pendulum will swing back. It's not going to swing all the way back though, because there's a lot to like about working remotely, and there's a lot for companies to like about it too. I mean, as you can draw on a labor pool that's so much bigger than you had before. Before you used to worry about somebody who can commute, an hour and a half getting to where your office is. You knew that you weren't going to keep that employee if it got to be much more beyond that. But this has so many implications beyond just office buildings, because it's going to be really interesting to see how this impacts commuting. Now, if you get out and you go on the streets in Toronto, it looks like, if you're driving on the Parkway, for example, it looks like there's still a huge number of people going up and down, but no, commuter traffic isn't what it was. So before the pandemic, almost every city in the country, in both countries, had a rapid transit expansion plan, some big plan about spending billions of dollars on Orange Line or Purple Line or Blue Line or whatever. And for one thing, those things are easy to postpone and you can save money. So if there's a concern about finances, they're the kind of projects that you can put off. But it's going to take a while to shake out to see whether or not the commuter demand is going to be there. And it's the same with airports. Not as many airport projects necessarily in Canada, because some of that work had already happened. But in the U.S., some huge airport projects. And it's going to take a while to see whether the spending on those is going to be warranted, and certainly not not brought forward as early as they were in the past. So there is talk about big spending on infrastructure projects. And I've always been a proponent of that in the past, but I think there's going to have to be some stepping back and seeing how things really shake out before anybody should just be leaping into massive spending on infrastructure projects this time around. Unless you go the PPP route, and then you're spreading around the risk.
Right. And we know that sector itself is doing a lot of navel gazing because of their heavy involvement as a project delivery contract module, you know what I mean, for transit and infrastructure, right? Yeah. So it's also looking to see, are we still appealing? What tweaks do we have to make? What kind of assurances do we have to give to stakeholders in a P3, you know, that this is still the viable way to go?
Yeah.
I guess I'll wrap up. This is my last question as we wrap up. Is you said, we started off this conversation, you said, you know, feeling a bit more optimistic than you had been for most of 2020. What is the first kind of bellwether, maybe, is it the first JOLTS report, the first StatsCan report? What is the first bellwether moment you're looking at in 2021 to give you a bit of an indication of where we're at as far as recovery moving forward? Is there a particular one? Or is it just going to do what you do? You know what I mean? Week to week, report to report. But is there in particular something that may give you a bit more insight?
Well, when I'm looking at the U.S. Statistics, so the one that I really like, and I always mention this, is the initial jobless claims report that comes out every Thursday morning. Sometimes people look at the stock market and so on, but the stock market isn't the economy. I mean, it's good news in some way that prices are going nuts and so on. I mean, you know, the high tech stocks, the FAM stocks, are just doing fabulous, and there's some justification for that, but their PE earnings are maybe getting kind of out there. But the clawback ratio that I talked about before, the jobs clawback ratio, I like that. But the one that's really simple, it comes out every Thursday morning, and it's the initial jobless claims figure. And that number, it dropped below 200,000 at one point. When the U.S. economy was really ticking along, the figure got to be quite low. In the last recession, the number peaked out at 655,000. Well, of course, this time around, there were a couple of weeks where it was up in the millions. So the number has been coming down, and but the last week it went back up again. It went back up by about 70,000, and that's a reflection of COVID coming back. So I'm looking for that initial jobless claims number to come down around 400,000, even better if it gets down to around 300,000. It's been above its previous peak number for something like 37 weeks in a row. Now, that's the economic indicator. That's tied to the infection rate. So if you're looking for an even simpler indicator, look at the COVID infection rates in both countries, and if it's decided that the economies can open up again. So, yeah, infection rates, jobs, those are the things that you watch for first.
Okay. Well, Alex, thank you so much for all that insight, and I encourage our listeners, those of you who are familiar with Alex, know where to find his material on the Canada websites, the DCN websites, but you can find them on Twitter as well. Plenty of great insight, and as I said, a very wise man who knows a lot about the construction economy, and who's a great colleague and resource for us in the news team and for this industry. So with that, I really thank you for making the time to talk to us and our listeners.
Oh, thank you very much, Vince. It's a pleasure for me, and this will be broadcast after the holidays, I gather, but best of the season, belated best of the season to everybody.
Yes, definitely. Thank you so much, Alex.
Thank you. Thanks, Vince. Take care.